Tom Winmill, the portfolio manager of the Midas Fund and CEO of Winmill and Company, is still bullish on gold. He joins us now with his assessment of the gold market and where it is headed. Tom, welcome to Bloomberg News. Nice to meet you.
Oh, it's nice to meet you.
Have you in on a day where we have Natixis Commodity Markets giving its forecast saying that it's gold going to average $950 an ounce this year, 2.4% less than last year. Those numbers
not jiving with your forecast because you're more bullish,
yeah,
right?
I'm definitely more bullish. We're looking at Midas for about $1,400 by year end. So, but that's what makes a market, and we'll see. Midas Fund was up over 60% in the last 12 months, and I think we're focusing more on the equities, though, and I think that's where the real story is for people that are interested in the precious metal sector.
So maybe another wave of interest in gold because of the volatility in equities?
Well, we've seen gold track down a little bit here, and what I usually say is what you want to do is buy low, sell high. I think this is a good entry point. In the short-term factors, the fear factor, we see, everything's kind of good right now. There are some problems in the economy, but that could be mildly bullish looking forward if something bad happens, and then gold price typically spikes up.
Are you expecting inflation? Is that part of what other factors play into your bullish outlook for gold this year?
Well, Laura, that's exactly right. Inflation is probably the biggest factor. The fiscal factors, we have the $1.4 trillion deficit. That's not going away anytime soon, certainly not by the end of this afternoon. So monetary factors, that's kind of the only crack in the fly in the ointment, so maybe it could go lower from here. We saw the Fed raise the discount rate, and that's usually bad for gold prices.
Okay, and then where is the gold demand itself coming from? Central banks, ETFs?
Yes, both those. We've seen central banks, as you just pointed out, start to become net buyers in some countries, India and so forth.
And Tom, we're also, I guess, we're looking at hedge funds too, because the Commodity Futures Trading Commission is saying that what we're seeing here right now is that hedge fund managers, other speculators, they're increasing their net long positions in New York gold futures, according to our story on the Bloomberg terminal, by 4% in the week ended February 16th.
Well, it makes sense to use the futures market because there's such a low contango, interest rates are so low, but we're also seeing a lot of hedge fund interest in the GLD, the bullion ETF. Yeah. So Soros just announced a huge position. We've seen Paulson in there, the China Investment Large Sovereign Fund, also in the GLD.
All right, so we've talked about the commodities gold price, and I think you mentioned too there's some advantage to owning gold related stocks. So your picks that you brought with you today, Barrick Gold and Newmont Mining, and you told me in the commercial break you're optimistic because they're trading at a PE below the S&P 500. What else do these names have going for them?
Well, it's really neat. They have, I'd say, margin expansion, momentum. We've seen both these big guys beat the consensus earnings estimates because their costs seem to be going lower and their margins are expanding, higher gold prices. So I like both the management teams there. Barrick is probably the Tiffany of gold mining company managements, and Newmont has got an excellent operating group there, and they should show some positive surprises.
Are we looking at additional exploration, or what's the strategy right now for these gold miners? Where in the cycle, if you will, are they?
Well, exploration is usually a big trend, an important part. Smaller companies, these guys are really not showing a lot of growth. This is really just plain, blocking and tackling, stock picking. They're low, undemanding multiples, margin expansion. We think they're going to make a lot more money over the course of this year, attracting not only gold bugs and gold investors, but also just generalists that like the profitability.
And Tom, maybe as quiet as it's kept, it's not talked about that much. At least we don't hear people here at Bloomberg talking to us about about it that much. Demand in China is on the rise too, isn't it?
Demand for gold.
Yeah.
Absolutely. China is the world's largest producer of gold. And you know what? All the gold produced in China gets sold to the U.S., to the Chinese government.
Exactly.
And they retain a lot of it. That's why we see their reserves tick up. They just simply retain the gold that country produces.
What could blow your forecast out of the water? What's bearish for gold
Bearish,
prices?
more of this interest rate going up. We saw the discount rates rise. We talked about that. More interest rates going up. That's bad for hard assets. That could be very difficult. If we see more fiscal discipline in Washington, that will also be bad for gold long term.
But then, you know what, the fiscal discipline also brings that political component in there. It's, I guess, the whole psychology of the gold market is, what are we going to see out of Washington? What would you hope to see lawmakers do?
Well, as an American, I definitely want to see the deficits get under control. I think it's a very bad thing for the U.S. to be spending such a large percentage of its GDP and incurring all this debt. I don't think there are any easy answers except inflation. Traditionally, politicians choose inflation. No one gets hurt except savers and financial asset investors.